Welcome back. South African retailer Shoprite has been fined 1 million rand for failing to assess properly whether consumers could afford its loans. The company, which had turnover in its last financial year of 141 billion rand, was also ordered to appoint a debt counselor at its own cost, following what the regulator called reckless lending. Unsustainable levels of household debt, especially in lower income brackets, is a pressing social and economic problem in South Africa, which has just emerged from a recession but remains saddled with high levels of unemployment and poverty. The National Consumer Tribunal says the judgment comes after an investigation by the National Credit Regulator revealed Shoprite entered into credit agreements with consumers without conducting a reasonable and objective assessment of the consumer's ability to afford the loans. Well, yesterday, September 5, the South Africa's National Statistics Office published the GDP figures for the second quarter of 2017, indicating the economy expanded by 2.5% on a quarterly basis. The release was eagerly anticipated since it follows quarter 4 2016 and quarter 1 2017 data indicating the economy was in technical recession, having contracted by 0.3% and 0.6% in those quarters respectively. Now I'm being joined by a senior analyst, Sub-Saharan Africa at Frontier Strategy Group, William Atwell. Good afternoon, William. Thank you very much for joining us.
Good afternoon. Good afternoon. Hello from London. Thanks for having me on the show.
Oh, you're in London. Good to have you on the show, William. Right. Were you surprised by the latest SA GDP numbers?
I wasn't actually. I think it was fairly well expected that there would be a rebound to positive figures. This is really because South Africa had been saddled with, in addition to its many other problems, a severe drought in the first few months of the year. This has since receded, and so actually the biggest bounce back that we saw was in the agriculture sector, which expanded by over 30% as output improved. Similarly, as food prices came down, inflation has been moderating over the past few months, so that Q2 growth figure also reflects a big expansion of consumer spending. So spending by households expanded by over 4% in Q2. So that was a key growth driver as well, and I think a lot of people are expecting that.
Right. How was the GDP achieved despite the political upheavals in and around the Zuma administration, like the sacking of the finance chief, Pravin Gordhan?
It's a very critical question. Certainly, so for Q2, we see quite a healthy figure, over 2%. But I think when we look at GDP for the year, for 2017, it's much more moderate. So we're expecting only in the region of around 0.5%. And so that really does have a lot to do with this volatile political environment that we're in. So we're finding businesses are quite unwilling to invest at the moment. And so, the whole economy PMI, the Standard Bank PMI indicator came out yesterday as well. That shows certainly private sector activity is very weak at the moment, with very little domestic demand.
Now, the new finance minister, Malusi Gigaba, will be given his first budget speech in October. With this economic data released, what do you see to be the direction for Gigaba?
So it's a big problem, of course. The Treasury at the beginning of the year was expecting around 1.2, 1.3% growth for 2017. So the fact that they're not even getting half of that means that the revenue that's coming in from taxes is going to be quite considerably lower. So we're expecting a big hole in the budget of around 50 billion rand, around $3.5 billion. And so that's going to be a really key challenge for Mr. Gigaba as he goes into the October budget statement. What I think we're going to see happen is see a bit more detail about possibly higher tax rates or new taxes coming online to try and fill that gap. Of course, also some more borrowing, most likely, pushing South Africa's already high debt a bit higher as well. And the other thing he's going to need to outline in this budget statement is whether and how the government is going to offload some of its assets. perhaps sell some stakes in some of its business interests and in state-owned enterprises.
Now, this GDP report precedes credit rating decisions later in the year by Fitch, Moody's, and S&P. What do you expect to see from these rating agencies?
That's a very critical question, of course. The rating agencies are going to be watching very closely. As you well know from your viewers, South Africa, well, two of the agencies downgraded South Africa to junk. So we're waiting for one more to see whether they will do that as well. Whether they do or not on the external debt is perhaps less significant than whether the domestically denominated debt is also downgraded. I think quite a few more things would need to go wrong in the economy, so I'm not anticipating a fully junked scenario just yet. A lot will, of course, need to as we move forward towards the ANC, the ruling party's election, leadership election later in the year, how that unfolds will have a bigger impact, I think, on the credit rating outlook going into 2018. I don't foresee a dramatic move yet by the credit rating agencies in the coming quarter.
All right, William, just before I let you go, what does your own research at Frontier Group show about the future of South Africa's economy?
Future of South Africa's economy, I'm afraid no big takeoff for the next few years. Like many of the larger emerging market economies like Nigeria as well, but also Saudi Arabia, Turkey, and so on. We're not seeing Russia, for that matter. All of these markets are really moving into a much more moderate growth trajectory going forward. We don't see a big uptick, for instance, from commodity prices for the next several years at least. So it's several more years of quite moderate growth.
Right. Thank you very much for your time, William Atwell. William Atwell is a senior analyst sub-Saharan Africa at Frontier Strategy Group in London. And finally on the program, Egypt's non-oil private sector business activity shrank in August at the slowest pace since July last year, amid a decline in new orders and a jump in exports. The Emirates NBD Egypt Purchasing Managers Index for the non-oil private sector rose to 48.9 in August from 48.6 a month before, but remained below the 50 mark that separates growth from contraction. Output continued to decline in August, but improved from the previous month, with a related sub-index standing at 48.8 compared with 47 in July. And that's a wrap on the program. Thank you very much for being part of it. I'm Chimezie Obi. Welcome.